Hi everybody, and welcome back to video number 5 in chapter 21. And when we left off, we were looking at Selectro's income statement for 2025. And we went through this slide, but I'm showing it here for review. Now, when we go into 2026, the correcting entries in 2026 will be as follows. Here, retained earnings is going to be $16,000 debit. Deferred tax liability will be a $4,000 debit and will credit accumulated depreciation for buildings for $20,000. Okay, the debit to deferred tax liability is made to remove this account which was caused by the error. The credit to accumulated depreciation dash buildings reduces the boot value of the building, its book value, it should be, to its proper amount. Selectro will make the same correcting entry in 2026 whether it prepares single period, non-comparative, or comparative financial statements. Now, if we look at single period statements, Selectro may prepare single period statements or comparative financial statements. If comparative statements are prepared, then prior periods must be restated to reflect the correction of the error. All right, let's look at the facts. Continuing on with the Selectro example, we are going to assume that Selectro had a beginning retained earnings balance at January 1, 2026 of $350,000. The company reports net income of $400,000 in 2026. So the question then is, how do we prepare Selectro's retained earnings statement for 2026? And then we'll discuss how the 2026 income statement and balance sheet are affected as a result of the error from 2025. The solution is that Selectro will include the prior period adjustment, which we determined above, in 2026 retained earnings statement as follows. And here is Selectro Company's retained earnings statement. It starts out with beginning retained earnings. We correct the error here for depreciation, less the applicable income tax reduction for a total reduction of $16,000, giving us a revised beginning retained earnings of $334,000. We add net income from 2026, and that gives us retained earnings at the end of the year of $734,000. The balance sheet in 2026 would not have any deferred tax liability related to the building, and accumulated depreciation dash buildings is now restated at a higher amount. The income statement would not be affected. Okay, if we look at comparative statements, the facts are that Selectro prepares comparative financial statements for both 2026 and 2025. The error of omitting depreciation expense of $20,000 in 2025, discovered in 2026, results in a restatement of the 2025 financial statements. The question then is, which accounts would be restated in 2025 financial statements? Okay, as we look at that, the following accounts are restated in 2025. In the income statement here, depreciation for buildings would increase $20,000. income tax expense would decrease $4,000, and net income would decrease $16,000. Okay. In the retained earnings statement, retained earnings would have the $16,000 decrease resulting from the net income decrease, as shown here. In the balance sheet, accumulated depreciation for buildings would increase $20,000. The deferred tax liability would go down, decrease by $4,000, resulting in a $16,000 decrease in ending retained earnings. Selectro prepares the 2026 financial statements in comparative form with those of 2025, as if the error had not occurred. If the error had occurred in an earlier year, say 2024, then the 2025 retained earnings statement would show a prior period adjustment. All right, disclosures. Selectro must disclose that it has restated its previously issued financial statements, and it describes the nature of the error. Selectro must disclose the following. 1, the effect of the correction on each financial statement line item and any per share amounts affected for each prior period presented. And number 2, the cumulative effect of the change or prior period adjustment on retained earnings or other appropriate components of equity or net assets in the statement of financial position as of the beginning of the earliest period presented. Okay, so correction of errors and changes. Here, having guidelines for reporting accounting changes and corrections, in summary, has helped resolve several significant and long-standing accounting problems. 1, in applying these guidelines, the primary objective is to serve the users of the financial statements. And here, number 2, achieving this objective requires accuracy, full disclosure, and an absence of misleading inferences. Okay, so if we continue on with our summary of guidelines for accounting changes and errors, here in illustration, we have changes in accounting principles. And when we employ the retrospective approach, we are going to changing the financial statements at all prior periods presented. Bravo, disclosing in the year the change, the effect on net income and earnings per share for all prior periods presented. Charlie, reporting an adjustment to the beginning retained earnings balance in the retained earnings statement in the earliest year presented. And if impractical to do that, to determine the prior period effect, for example, a change in LIFO, Alpha, we do not change the prior year's income. Bravo, will use the opening inventory in the year the method is adopted as the base year inventory for all subsequent LIFO computations. And Charlie will disclose the effect of the change on the current year and the reason for omitting the computation of the cumulative effect and pro forma amounts for prior years. So if we have a change in accounting estimates here, we'll employ the current and prospective approach by Alpha, reporting current and future financial statements on the new basis. Bravo, presenting prior period financial statements as previously reported. And Charlie, making no adjustments to current period opening balances for the effects in prior periods. And if we have a change in reporting entity, we'll employ the retrospective approach by alpha, restating the financial statements of all prior periods presented, and bravo, disclosing the year of change, the effect on net income and earnings per share data for all prior periods presented. And if we have changes due to an error, we'll employ the restatement approach by alpha, correcting all prior period statements presented, and bravo, restating the beginning balance of retained earnings for the first period presented when the error effects occur in a period prior to the first period presented. Okay. Now, if we put this into practice for accounting for errors here, the Briggs Company is in the process of adjusting and correcting its books at the end of 2025. Briggs purchased a patent at the beginning of 2023 for $55,000. Briggs has not amortized the patent because its value has not diminished. The patent has a useful life of 10 years from the year it was purchased. So they want you to prepare the journal entry on December 31, 2025 to correct the error. We're going to assume straight line amortization here. So I think pretty straightforward here. Briggs should have recorded amortization for 2023, 2024, and 2025. Amortization expense is calculated as follows. We'll take the $55,000 divided by 10 years, and that will give us $5,500 amortization expense per year. So for 2025, the amortization expense of $5,500 must be recorded because the books are still open. For 2023 and 2024, the amortization expense of $11,000, that's $5,500 times 2, must be debited to retained earnings. Very standard correcting methodology there. The patents account will be decreased or credited for the accumulated amortization for the 3 years. So the correcting entry is going to be as follows. We will have amortization expense for the 2025 year, and we will have an adjustment to retained earnings for $11,000 here for the 2023 and 2024 year, and we will reduce patents by $16,500. Okay, let's analyze the effect of errors. Here, when we look at error analysis, companies must answer 3 questions. What type of error is involved? Number 1. Number 2, what entries are needed to correct for the error? And number 3, after discovery of the error, how are financial statements to be restated? Companies treat errors as prior period adjustments and report them in the current year as an adjustment to the beginning balance of retained earnings. Pretty straightforward there. The balance sheet errors affect only the presentation of an asset, liability, or stockholders' equity account. So for number 1, the current year error, we're going to reclassify the item to its proper position. And then number 2, prior year error, will restate the balance sheet of the prior period year for comparative purposes. That looks like a good place for us to stop this video. And when we return, we'll take a look at income statement errors. Until that time, bye for now.